investment advice and investment advisors. Do you need a financial advice? There are four big reasons potentially. If you are suffering a huge financial loss and your portfolio didn't recover even after the markets recovered after 1 or 2 years of a big dip, that means you've not chosen the right stocks or bonds or the right combination. If you have a busted budget, don't know or have a clear plan of earning, spending, saving, borrowing, investing, then you need help. If your portfolio is chaotic, hundreds of ideas, 40 different bond funds, 30 different stock funds, way too much going on, you need help. Had a major life change, planning for kids, retirement, aging parents, self-employed, and need help with a lot of new tax laws and rules and regulations, you need help. So let's look at the kinds of help that are available out there. The state of investment advice today consists of a bulk majority of people, bulk of users and investors who are amateurs. And based on the recent survey, investment advice comes from relatives, friends, commercial bankers, stockbrokers, financial service companies, the newsletters. If you are a high net worth, then you have an advisor dedicated, CFA, financial analysts, chartered financial analyst. But the numbers here look really surprising. 17% use spouse or friends for financial advice. 16% use a broker. 10% financial products, 8% internet, 3% television, 24% planner. So based on this survey, it looks like there is no systematic or a methodological way that investors have found out to get meaningful advice. It's all over the place. And it's a very unique place to be in. It's the only business operation where you ask advice and from others as to how to make money. So let's go through each one of these and see what the efficiency and effectiveness of each one of them is. Investment, counsel, trust services, or the banks. The main objective of those people is to shield the investor from costly mistakes. That's the main part. And conserve the capital. So growing the money is not the main objective. So if you go for trust services, investment counsels at the bank, the conservation of the capital is the main objective. So knowing the main objectives of each of these people will help us to know if we are using the right set of advisors. Financial services company, they provide regular newsletters. Their main objective is to do an in-depth study of the business and provide decision guidance based on the business's health, the current state, and the future prospect. So these people, like Moody's and others, they cater to a wide range of audience. So getting a tailored, specific advice is very hard because the audience is huge. Usually in the recommendation, they have a hedge most of the time because then they can't be proved considerably wrong in the next few weeks or few months. So tailored recommendation requires a huge net worth. Technical forecasting based on technical analysis, another artifact that financial services companies provide. So based on reading this book, the best is to ignore this as a starting point, but only as a spot check, as to see if you didn't shoot way off in terms of the price of the share that you're trying to pay. Stockbrokers, their main objective of making money is commission and fees. Very important to remember this. The most profitable client for the stockbroker is the speculative client who wants a speculative advice. So if you're reading this book and if you've gone through so many of these chapters and following these videos, you're not a speculator. You are an investor. So be highly, highly cautious with taking tips from a stockbroker. Unless that stockbroker is your close relative or a family member, you should probably almost be ignoring stockbrokers. Also, they hedge quite a bit in their analysis. Some of them do also produce technical analysis and forecasting. So far, we've reading this book, technical analysis and forecasting is something that we should be, as a value investor, as a long-term investor, should be ignoring in a pretty big way, but only using it as a spot check. So using a reputable stockbroker is very important. What if they go broke? There have been instances highlighted in the book where the broker used all of the leverage that he had for not his money, but the people's money, and went bust, and everyone lost money. Many rules have been set in place to avoid this, but good stockbroker and avoiding them for advice, because most likely it'll be a speculative advice if they don't know you well, or if you don't know them well. Certified financial analyst is the way to go. These people are trained. They've gone through rigorous exams. Their job, main objective, is to do in-depth security analysis, create tailored asset allocation portfolio for you, help you with your financial planning and your financial statement. They do a lot of study to find out if a particular stock or a bond has, based on the price, is good to buy based on its intrinsic value. They help with asset allocation tailored to your needs. But make sure you check what the reputation of these people are. They'll also be helpful for you for your financial education and spend considerable time with you for advice, information, etc. Interview your chartered financial analyst. Find out if they really care about helping clients, understand the fundamental principles of investing laid out in this book. One other thing that I found out is Benjamin Graham, the author of this book, pushed for this degree called CFA. It didn't exist before him. He spent considerable amount of time to get chartered financial analysts as a degree that have specialized skill set of people who are reputed and who are good at what they do. So it was he who helped with the CFA. So make sure they're sufficiently trained, highly experienced. Do you understand what they're explaining to you based on the questions you ask them? You should ask them a lot of questions. See if they have a lot of clients. How many clients? How do they communicate with the clients? What happens if there's a loss for a year? What is their worst year or worst client performance experience look like? How high of an average return do they think they can provide with the strategies that they have? Will they be willing to share your resume, referrals? Do they have any formal complaints filed against them? Get to know them and make sure they have a genuine interest in getting to know you. Only if there is a perfect match that you should get a CFA. And get a CFA who is fee only. There's no commission. Investment bankers, the main objective is to get investors to buy into, to provide money into businesses that are expanding. So they are the core engine of creating finances and liquidity. They help with the new IPOs. They underwrite, and that means they guarantee that all the securities will be sold. They are the connecting bridge between the investor and the person who's trying to sell their businesses. They also deal with banks, with insurance companies, and make deals around bond offerings and a whole host of things. We've gone through this video on IPOs in general. Beware. Friends, spouses, miscellaneous. Main objective, no idea. It's very critical. So I've taken this paragraph from the book. The book takes a very critical attitude towards the widespread custom of asking investment advice from relatives or friends. Remember, 16% plus. This was 10 years ago, so I think this number is higher up now. The inquirer always thinks that he has a good reason for assuming that the person consulted, in this case could be the friend, has a superior knowledge or experience. According to Benjamin Graham, his own observation indicates that it is almost very difficult, if not as difficult as picking a security, as picking an advisor. So if you ask anyone for a financial advice, you're in real bad luck. So avoid doing that. Much of the bad advice is given for free. Critical, very critical about this. If you are one of these, you should not be playing this game. This is not how you would make money in the long run. So in the summary, validate the price that it's not too high by using some of the spot checks from various techniques and people. Use some of the strengths of each of these folks and understand the main objectives of each of these folks. And only ask CFAs who are really good about advice. Trust them and verify their integrity. There's various ways you can use that help to create a comprehensive financial plan, which states clearly how you're going to make money, earn income sources, how you're going to save some of that, what are your spending habits, what kind of borrowing, mortgage, etc. you have, and what money would you be investing and where. So they'll also spell out with you investment policy statement that you create. It's a one-pager that clearly articulates your approach. So once you have the input, then you have the approach, which the investment policy, and then the allocation. Once the approach is there, it has to strictly follow the allocation as to what percentage of money would go in stocks versus bonds versus various types of specific investment common portfolios. So create the plan mutually working with your CFA. Don't hire a CFA if you don't 100% see a match. Only if you're fully satisfied that you want to trust someone. All right, hope you liked it. It's very important. Financial advice is everyone wanting to do that, but you want to be very careful. Good luck.